Have you ever opened your chart just to see price action as unclear as this? This has probably left you confused on what to do and where to start your analysis. In this video, I will be showing you how you can frame your entire bias based off only one candle. From this one candle, you can frame your bias, take entries, and simply use it as your bread and butter strategy to be profitable in the markets. Now, with all that said, let's get straight into the video. Firstly, if you've watched my ICT daily bias video, which I've made about a year ago, or if you watched one of my more recent videos, such as my candle range theory video, you would have realized I've briefly touched upon this topic. However, in today's video, I'm going to be doing a full in-depth guide on this strategy, this topic, this concept, whatever you like to call it, as there is so much info and value just in this one concept alone. Now, you may be thinking, this is just one candle, there's not much to take from it. However, for those of you who know how candle theory works, how candle anatomy works, and what makes up a candle, you'd realize that one candle actually tells a bigger picture and a story. So if you are familiar with open, low, close, high, so here we have the open of the candle, we have the low of the candle, we have the high of the candle, and we have the close of the candle. What does this mean? This means simply price has opened right here before we've came down, formed the low of the candle, before price has pushed up all the way to the high of the candle before closing at the close of the candle. But why am I telling you this? Because within this movement, you'll begin to see, sorry, just give me a second. We have the opening price and we have manipulation below the opening price. Once we form the low, not only is there liquidity here, there has also been a manipulation here of this liquidity right here. So furthermore, once we get the move to the upside, we do form more liquidity up here at the high of the candle. Now, for instance, if this was a daily candle, we could say this is the previous day high and the previous day low. So there is a large pool of liquidity above this high and above this low. And as I touched on the manipulation right here, let me just clear the drawings as it's starting to get a little bit unclear. As the manipulation we get below the opening price, if market were to consolidate here and we were to come down, take out this liquidity, manipulate price, and we get the distribution. What is this? This is the power of three. So within one candle, you can get the power of three, liquidity, you can get bias, but it just requires you as a trader to have the understanding of what one candle really is. With this understanding, if we are looking at one simple candle, the best place to buy is right here in the wick. Now, if we were selling, if this was a bearish candle, the best place to sell would be up here on the wick. This brings us on to drawn liquidity. Now, understanding that at the high and the low of candles, there's a significant area of liquidity, we can know where market is going to move, as liquidity is a magnet area for price. If we have liquidity at this low, and first we have a bearish candle printout, and we have a following bearish candle printout, is price more likely to take out the previous day high or low? Now, most of you will know it's very simple. Price is more likely to take out the previous day low in this scenario right here. Understanding on each example, such as this example, we have market open, we have a manipulation up to the high of the wick before we have candle carry down to the low and where current price is trading. So we should expect market to move further to the next point of liquidity, as if you guys know, market is always trying to take liquidity. It is the magnet area for price. Same in the bullish example. We have candle closer here, we have liquidity form, we have liquidity taken out to the downside before market comes up towards this high, and we have market currently playing out at this area right here. Now, we are pretty close to this previous day high, also this candle high. So we have two draw on liquidity, which market would be aiming to take out. Another reason why in this example, price is more likely to take out the previous day low, and in this example, price is likely to take out the previous day high, is because the continuation of candles. If we have one bearish candle and we have a second bearish candle, likelihood of the third candle being bearish is very, very likely. Now, again, here, bullish candle, the likelihood of the next candle being bullish is very likely. Now, this theory remains true until market fails to have a body closure below or above the previous day high or previous day low. So, for example, we have market come, and let's say in the previous example, for example, we have market coming and you think it's coming to take this previous day low. However, before you know, you check market again, candle has completely reversed towards the upside. This indicates a reversal in trend. Now, the logic behind this is pretty simple. Market has came to take the liquidity before coming to reverse. market's taking the liquidity before coming to reverse. And as you guys can see, we do get body closure within the previous day high and previous day low, the previous day low and previous day high. Within our trading range, we get body closure back into the zone, which most likely would assume a reversal. So what would I expect next for market to do? I'd expect in this scenario right here, another bearish candle, or in this example right here, another bearish candle, which would bring our drawn liquidity in this scenario to the previous day high, and in this scenario to the previous day low. Just for more confidence, it's very important to understand swing points, previous week high or lows. If you're on the 4 hour, it's good to check the previous day high and low. If you're on the 15-minute, it's good to check the previous 1 hour candle high and low. You always want to go up a time frame. As the higher the time frame, the stronger the time frame is. The weekly time frame has more conviction than the daily. The daily time frame has more conviction than the 4 hour time frame. In this example, as you guys can see, not only have we taken the high of Thursday's candle and we are going into Friday, what I can assume for next week open is the Monday candle is going to come, take the week high, and we are going to reverse from there. From using this swing point, this previous week high or low, in our example is the previous week high, I can assume now that the Monday candle is bearish, Tuesday will be bearish, Thursday will be bearish, until I see a reason to believe otherwise. Now, if my bias was wrong and Monday ended up closing way above the high, and as I can see, there is body closure above the week high, I would assume market is bullish for the week. Let's see how our theory works out on USD on the daily time frame. So to start off, we are clearly in an uptrend. That's just one of my confidences for market being bullish right now, plus this order block right here, which market has just tapped into, and as you guys can see, we are getting a reaction off. Now, if I play out the next candle, I'm going to hope that we are going to take out the height of the candle, which we do. However, we do close back within the range of the candle. So my only next guess is for market to either come close lower, or we are going to take the week high. If I play out the next candle, we do take out the high of this candle, and as you guys can see, we now are confirming our bias towards the upside. From here, as we have body closure above the high of this candle, I'm going to assume market is just going to take the high of this candle, coming closer towards our week high, which we do. And let's play out the next candle again, marking out the high. We do take out the week high in the end. Now, from here, we could get a reversal. However, we've had a body closure above the high. So if I play out the next candle, I'm going to assume it's going to take the high, which we do end up taking the high. However, we sweep back into our range, as you guys can see right here. So from here, I'm going to assume we are bearish. One, the close above the high, above a significant liquidity point. Second, we've had liquidity taken of this previous day high. So if I play out the next candle, we get a strong close towards the downside. I'm going to assume market is going to take out the low, as we've had a body closure below the low. Play it out, and we do sort of, I wouldn't say that's strong enough. As you guys can see, we do get a very strong wick where we are, market is trying to sweep liquidity. We do not sweep this low, however, we do sweep this low. So next candle, I'm going to assume is going to be bullish for this, for these reasons. However, we are not. Now, it does not work 100%, but you guys can see I am correctly guessing the bias of each day about 90% of the time. Now, how can we take this concept and turn it into a high probability setup? The most important part, actually trading this concept and becoming profitable from it. We are going to implement two key confluences. The first is time frame. So if you are trading this on a lower time frame, such as the 4 hour or the 1 hour, you want to make sure you're avoiding Asian session. Now, this is because the price action on Asian session is not as clear as it is on, let's say, London or New York. You'll get a lot of consolidation. The closes above highs, the rejection candles, they will not be as clear, and often the win rate is lower on Asian session as compared to London or New York. Now, secondly, we're going to implement PD arrays. Now, if you do not know what PD arrays are, there's things like order blocks, fair value gaps, old highs or lows. There are also rejection blocks, breaker blocks, etc. So we want to align this one candle theory along with a PD array. So if we have a fair value gap where market is playing out in, this would be fantastic to add it as a confluence towards your bias. Let's see how it would all look put together. So firstly, on the daily time frame, we have a fair value gap right here. Now, if I play out market, you're able to see market does come tap in. And if we play out market a bit more, you can see we are coming towards the 50% mark of the fair value gap. Now, from here, I would be looking to take entries based off where I can see a reversal. And right here is the first candle where we get that sweep of the low of the candle, and we get a reversal to the upside. As you can see, we have a bearish candle. Now we have a bullish candle. Now, where is the best place to buy within this scenario right here? Now, as I've said earlier, the best place to buy is at the wicks below the opening price. Now, we have all confluences lined up. We are in an uptrend, as you guys can see. We've tapped into a PD array, which is a fair value gap in our example. We've made it to the 50% mark of the fair value gap before we've had a bearish candle printout, then followed by a bullish candle. However, we've had the low of the candle swept, indicating a reversal. So let's hop down to a lower time frame such as the 15-minute to try and find an entry. Now, as you guys can see, I've marked out the low of the candle anyways. So we have Asian session liquidity building up right here as well. So this is more added confluence if market was to take out the low of Asian session or the high of Asian session. So I'm going to wait in our scenario for market to take out Asian session before I enter. So let's play a market. As you guys can see on the first candle, we do take out Asian session. If you were to simply enter off the liquidity sweep as shown, stop loss, you want to give trade a little bit of room to play out. And as for take profit, as I was saying, you could have targeted the Asian highs. You could have targeted liquidity points such as this liquidity point right here. However, market did end up running all the way up to this point for a nice 1 to 10. So if I play out market, you guys can see price absolutely melted through our zone and smashing full take profit just as shown. Now, the reason why this trade was so successful is because my bias for the day was correct. I outlined the low and the high of candle, identified key liquidity zones with significant areas of liquidity. I saw the sweep, I saw the reversal beforehand, and I managed to catch the trade before the market actually reversed. This all comes with building up confluences. Now, this strategy alone, this confluence I should call it, where you are marking out highs and lows of candles, this alone will not make you profitable. You have to build up your confluences in order to take a trade. Now, in my case, I saw market was in an uptrend on the daily time frame. I saw we're playing out in a PD array. I was in the daily time frame. However, if I wasn't, I would have looked for us to be in London or New York session. I dropped down to my time frame. I saw Asian session. All these confluences build up, as well as my take profit. I placed my take profit at liquidity points. All these confluences build up, building a narrative for each trade. Do not mindlessly place trades. Make sure there's always a reason you're placing each trade. And if you do so, you'll be very, very profitable, and you'll be surprised of how far you can actually go. Let's move on to another example. Now, I can see here market is clearly reacting off something as we do get a rejection block. And if I do just check on the markets, it is this order block right here, which market is reacting off. Now, within these two candles, you can clearly see our bearish candle does sweep the high of our bullish candle. So bullish candle, we have market close, and we do have a sweep of the high right here. So from here, I can assume we are bearish. 1, we have a PD array. 2, we have this sweep of liquidity, or market come and reject this high right here. So from here, it's as simple as using everything I've taught you in this video, compiling all the knowledge together, and using other concepts you may know, such as order blocks, fair value gaps, dropping down to the 15-minute. And there's many places where you could have caught your entry. First, we do have Asian session liquidity again. So you could have simply entered off the liquidity sweep, just as I did in last example. So if you did that, you could have still been profitable. Or if you wanted to take a more traditional approach, a more IST framed approach, you could have simply done a market structure shift here. You would have identified, and you would have seen this fair value gap here. And this fair value gap is significant because it is the one that caused the market structure shift, is the one that displaced below the low, meaning it is the valid fair value gap. Enter off the 50% mark, place your stop loss either at this high or all the way up at the Asian highs, while targeting opposing liquidity. Now you could have targeted this low, whatever. Let's aim for 1 to 3. So play out the trade, and you guys can already see we are in profit before market smashes through our take profit as shown. Now you guys may be asking, where is the step-by-step strategy? However, I'm here to tell you that the biggest problem in traders nowadays is they trade with absolutely zero conviction. So they follow a step-by-step plan just like robots. If there is a order block entry, however, their rules say there's a fair value gap entry, they are not going to take the entry. If there's a liquidity sweep, however, their rules say they need to enter off a fair value gap, they will not enter. Now, entering is not always the smartest case in the market. Sometimes the smartest option is just to not trade. However, if you guys follow your rules like robots, you will never be profitable, as you are simply trading like a robot. You are not a robot, you are a human. You have creativity. You are able to analyze the market like a specialist, using your brain, noticing what's happening and being able to adapt is what makes you a great trader. It is all up to you how you want to trade. You can copy how I trade this strategy, where I look at my bias, I look at where market sweeps liquidity to, I look at my PD arrays, and I simply enter on the lower time frame. You can do that. However, if you have something else that works for you, you can use it. This is simply an added confluence. As I said earlier, guys, you need to build up your confluences to build a narrative for each trade. Now, thank you guys so much for watching today. If you guys managed to learn anything new today, make sure you guys like and subscribe. And if you do want to learn more and really take your trading to the next level, check out the VIP room, where I post my signals, my analysis, where I help traders all become profitable and reach their trading to the next level. So thank you guys so much for watching, and I'll see you guys next time.